That is the closing bell on Wall Street, and now it's Market Domination Overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. We've got Lou Basenese as well as Yahoo Finance's Jared Blickery. They're joining us here to break down the moves today. Jared, let's start with you on that close.
All right, a little bit of a downdraft today in the Dow. That is going to be down 142 points, or about 1/3%. Thought we'd take a look at the day's price action. Underwater for almost the entire day, except for the open. Here is the 5-day total. Still underwater, but just by a tiny little bit. NASDAQ was the winner, the big winner of the week, up 1.5%. And that is going to be another record for that index today. S&P 500 slightly underwater by just 1 basis point today, still up 0.6% for the week. And let's take a look at the S&P 600 for the small cap action. That is ending the day and the week, both down by about 0.8%. And if we go to the sector action, we can see utilities still buying away, the largest gainer of the day, up 1.67%. After that, you have consumer discretionary, then real estate staples, and also financials in the green there. Energy finishing the day down 0.8%. And let's get a quick tally on the week. Tech, the big winner, hence those big NASDAQ gains. Utilities in second, thanks to today's price action. And then you have industrials, financials, and real estate. Energy, the biggest loser, down 3.5%, and healthcare down 2.5%. Materials also putting in some negativity right there. This is the NASDAQ 100. This is a 5-day look. NVIDIA had a bunch of record highs this week, up 4.5%. Tesla actually finished up a little bit more, 5.1%. And let's just take a peek at what happened today. Tesla up 3%, Netflix down 5%. We've been talking about that. MicroStrategy down 6%. And I will end here on the Dow, kind of a mixed board. Aside from the mega caps that we just took a look at, we're seeing 3M down 3.5%, American Express down 2%, McDonald's and Merck each down 1%, so is Amgen. And again, those healthcare losses continue, but it's really been a story of tech this week and some of the smaller issues as well. Meme stocks, we'll get into that, Josh, in about 30 minutes.
And Lou, I want to get your take as well. Jared doing a great job wrapping up the week. Your thoughts on the week, Lou? Part of it being, listen, got a rush of economic data this week, Lou. I think broadly you would say solid.
Yeah, all calm on the home front with the economic data, right? Good retail sales report. Inflation really isn't anything there to worry about immediately. I think tech has remained in the driver's seat, which is what we need for this market. Strong earnings across financials. The surprise, the shocker to me is small caps still struggling to get a leg up. But I really think that this market is in a mode where it's cruising into the big 2 weeks of big tech earnings, ready for them to either disappoint or continue to outperform, which will lead this market higher.
And Lou, we talked to Chicago Fed President Austin Goolsbee on the show today. Curious to get your thoughts on the Fed. Are they cutting this year, Lou?
I think they're cutting. I think they're going to be forced to cut in September. The president had been trying to throw a political football about cuts to Powell. Powell just stopped even trying to catch it. I think that gives him cover to make an independent decision based upon the data, and we just haven't seen it show up with inflation and the tariffs.
And Lou, let me ask you this, though. I talked to Ed Yardeni this week, economist, strategist, all around very smart guy. Now, he told me, Lou, they're not cutting this year. He said they're not cutting this year. That's what he tells his clients. If, Lou, Dr. Yardeni is right and they don't cut, can the market still move higher?
Listen, I was with Kenny Polcari, a student and believer like Yardeni about this, no cuts this year, but I've changed my mind. I think the market needs a cut this year. They need to see that the Fed is going to move off of pause into 2026.
Jared, does the market, my friend, get your take on this, does the market need a cut, Jared, to move higher?
I don't think it necessarily needs a cut. I think the dollar is going to head lower. I think that's going to be enough to propel this market, keep propelling it to new highs. We had a really great 3 months. We were up something like 26% over those 3 months on a rolling basis, and we're taking a little bit of a pause in the S&P 500. But tech is roaring higher here. We have global M2. That's the money supply all around the world. The Chinese are printing. U.S. money supply is up. And when you have this, and we're at multi-year highs right now, we're going to talk about this in 30 minutes too. When you have this situation, this setup, guess what? You tend to see that in risk assets, and that's stocks right now.
Thank you, Jared. Another earnings season kicking off this week, but expectations are high this time around. Joining me now for more is Yahoo Finance senior reporter Allie Knau. Allie.
Yeah, that's right, Josh. Earnings season's in full swing, and Wall Street is making one thing clear: good just isn't good enough. So why are we seeing these types of reactions in names like Netflix, even some of those big bank earnings, despite the fact that they really performed well in the quarter? So Netflix right now closing the day down 5% over a 5-day period. We're at a loss here, down around 3%. But if you take a look year to date, we have just been soaring on this name. The stock is up nearly 40%. We were up even higher before we saw the declines this week. And this is a company that just continuously outperforms on the earnings front. The stock is trading at 40 times forward earnings. It's about double the value of the S&P 500. So there were a lot of question marks heading into this report about valuation. And you're really seeing that across the board here. Even if we take a look at some of those big bank names like JP Morgan, for example, Bank of America, these banks had pretty solid results too. Over a 5-day period though, some muted gains, muted reactions here. And one reason is because we're just in this stretched market. And this is coming as earnings, the bar has already been set low. So there is no patience for any type of misses here. So we asked Wall Street strategists about this week. Here's a little bit more of what they told us.
We've had this 25% rally off of the lows, right? So expectations from that perspective are much higher. Now, I do think we've seen pretty muted responses to very solid numbers, kind of thus far throughout the quarter.
I expect that we're going to be seeing a lot of volatility in terms of the companies that are meeting expectations, probably fine, but the misses are probably going to get punished a lot more than usual. I don't think investors have the patience to really deal with companies that are missing with any of those estimates.
For me, it's like how many people say for now at the end of the sentence, right? So I said all the flags are heading in the right direction for now.
So Mark Malik making that point that there's still a lot of uncertainty here within this market, especially when it comes to tariff and policy unknowns. You guys were just talking about what the Fed could be doing. That's also an overhang in the market as well. And we'll be hearing from more companies throughout the course of earnings season, especially those that are more sensitive to the tariff front. And hopefully that gives investors a little bit more clarity. But at least from what we saw this week, the bar was low. However, investor reaction is certainly high, and good just isn't good enough.
Lou, get your take as well. Earnings season, we're early days still, Lou, but you got the big banks, a lot of big tech on the way. What do you make so far of what you heard?
Early, it's usually beat and rally. I think we're going to get beat and delayed rally, just because I think everyone wants to see that the majority of the market is going to beat expectations. Remember, last quarter, earnings were only supposed to be about 6% growth, and we got 12%. I think you had lowered expectations going in. As we get through the big tech names, you see that continued outperformance. There's a lot of room to rally from here.
What are you listening for, Lou, on the call? Some of the themes: tariffs, consumer economy, and as we get deeper earnings season, I've had some strategists, Lou, on the show tell me they expect to hear more CEOs and CFOs decide, you know what, there's too much uncertainty, I'm not offering guidance. I'm not going to offer a forecast. Why put my neck out there? Is that what you expect?
Yeah, I don't expect that, because last quarter we had 51 S&P 500 companies actually raise guidance talking about that forward, which kind of goes against the grain. I'm really looking for how much decrease we see in the mention of the word tariffs, how much increase in the word AI, and then really what's the guidance, right? You can have a quarter that's so-so, but what are you looking for moving forward? And people raising guidance, that would be the real tell to me that this market can move higher even if we don't get an interest rate cut, because earnings are going to go higher.
Ali, on these calls, I'll ask you also, a lot more calls you're going to be monitoring. What are some of the themes, the trends you want to be listening for?
Yeah, I think Lou brought up a good point that we seem to have reached peak uncertainty when it comes to the tariff front. Companies seem to have a little bit more of a gauge on where the future of the economy is heading, especially since the hard data, retail sales, for example, coming in strong this week. We have jobless claims at solid levels. So overall, the health of the U.S. economy seems stable for now. That is the overarching theme here. So I'm just looking more into what companies are saying about the resiliency of the consumer, whether or not they're seeing any cracks underneath the surface. And to that point, we have not heard that. All the big banks have called out a resilient consumer. Netflix on the call last night said they're not seeing any trading down. They're not seeing any different purchasing behaviors. So far, everything seems to be honky-dory on the consumer side. However, there is this emerging trend when it comes to high income consumers versus those lower income consumers. So I'm curious to hear from some of those other companies that maybe are more exposed to that type of consumer to see if there are any deeper cracks underneath the surface.
One more quick one, Lou, as we head into the mouth of earnings season here, right? Given this summer melt-up we have seen, are any concern to you that we're looking in any way frothy here?
Yeah, I mean, valuations are definitely getting stretched. I think you have to be a stock picker, not an indexer in this market. I mean, if you look, you talked about Netflix. Ali was saying it's at 40 times forward earnings. That's rich by anyone's metric. We talked about energy before, trading at really low valuations, about 15 times forward earnings. So I think this market conditions with the earnings growth is good for maybe another 5 to 10% in the major indexes. But if you're looking for double digits for sure, I think you got to become an individual stock picker.
All right, thank you, Ali. Appreciate it. Well, recent data is showing more concerns for home buyers. We're going to break down the latest housing hurdles on the other side. Stick around. More market domination overtime. That's coming up. President Trump gearing up to sign an executive order to open retirement plans to private markets. Senior columnist Kerry Hannon is here with more. Kerry.
Yes, the president is expected to sign an executive order directing the Securities and Exchange Commission to give guidance to mutual fund administrators, to 401k plan specifically administrators, of how to add private assets into their retirement account offerings. And this is sort of a big deal. The fact is, private assets have been, it's not illegal to have them in retirement accounts as it is. And pension funds have done this for decades. But the issue is most plan administrators don't really understand how to fold those into their 401k plan offerings. And there are some really good things about this. So we'll start with the pro stuff. If you were to put, and this can be a variety of assets, right? It can be hedge funds, it can be private real estate things, infrastructure, a variety of things that most people don't quite get a grip on. And to get into those assets, you needed to have pretty high net worth, or the minimum requirement to invest was fairly high. So the point is that this could actually help people, give them an extra boost in their retirement accounts. It adds diversification to these retirement accounts. And when you think about people are living longer, Social Security shortfalls that people are worried about, cost of living is going up. So for people who are investing for the long run, and Larry Fink at BlackRock said, over a 40-year period, these private assets could, return 15% to someone. So this is rather significant if you look at it that way. But if you turn the corner and look the other way, if it's somebody who is not investing for the long term, they need to get the money out in a shorter time frame. These tend to be fairly illiquid. The fees can be high. And there's a concern that people don't really understand what they are. And I'll just finalize that by saying, most people don't have a clue what they're investing in anyway. Most employers automatically put their employees in target date funds, which are plain vanilla index funds, and people set them and forget them. So it will take a lot of education for people to understand, and I'm a big fan of people understanding what they're investing in. But it's not all a negative thing. These can have some real good boost ultimately over the long run. If someone did a small percentage, I would say you wouldn't want more than 15% of your portfolio, your retirement savings, in private assets.
All right, Lou, get you in here. So let's say, Lou, I'm private equity now, Lou. I'm Blackstone. I'm KKR. And I say to you, Lou, all I'm trying to do, Lou, I'm just trying to give people more options. I'm trying to give them more choices, right? Some more diversification. What's wrong with, maybe a chance to have a meatier return? What's wrong with that?
Yeah, I'll play this game. I'm with Kerry. There's a lot of cons, but if you're BlackRock and KKR, I know this pension funds and endowments aren't allocating as much money to you, and there's a huge pot at the end of the rainbow of about $9 to $12 trillion in 401k accounts. That seems really appealing to sell these highly illiquid, not transparent, high-fee products that could or could not outperform the S&P 500. I'm with Kerry. Education is paramount. 43% of people only consider themselves financially literate based on a latest FINRA study. That's a lot of people we got to educate before we give them access to things that are really difficult to understand.
And Kerry, Lou makes very good points, as always. But would the private equity guys say, Kerry, would they say, listen, you know what? Finance changes, investing changes, public markets change, and you got to change with it, and so does your portfolio.
Well, you know what I got to say? These are coming no matter what. So I think we can talk all we want, but I think this is definitely something that is coming down the road. Yes, things do change, but the old 60-40 portfolio, which most retirement investors have been encouraged to have over the years, mixture of stocks and bonds, has done pretty well over time. But yes, we are in new times. But I just, I think it's good to offer some extra oomph to people if that's possible. But it's a really tricky thing because this is money that people are socking away to really for their futures. And if they do, we see people pulling money out of their retirement accounts right now, taking early distributions. And this would be not a good situation.
Kerry, great to see you as always. Enjoy the weekend.
You too.
Well, the U.S. housing market landscape remains tricky to navigate. U.S. single-family housing starts declining 4.6% in June, while mortgage rates rise for a second straight week. Meanwhile, home builder sentiment has been in negative territory for 15 consecutive months. What does it all mean for home buyers? Well, here to discuss is Realtor.com chief economist Danielle Hale. Danielle, great to see you. Let me start with that data today because it was interesting. You actually saw June housing starts. They rebounded, Danielle, by 4.6%, but it sounds like that was mostly a surge in multi-unit, and then it was the single-family starts, which would tend to be more reliable. That did sink 4.6% in June. What is going on there, Danielle?
Yeah, so it's great to be here. Thanks for having me, Josh. When we look at the housing data that we saw today, construction rebounded from a pretty weak May, but it was driven by construction in multifamily. And so for someone who is going to be a renter, that really matters. That multifamily often affects rental supply. But if you're looking to buy a home on the single family side, that's where you want to pay attention to. And we did see a pullback in single family housing starts. That's true whether we're looking at permits or starts. And it was a pretty significant pullback. And then if we look at the overall completions, those pulled back across the board. So that, to me, reflects builders trying to manage their pipelines amid a really challenging environment where they're facing a bit of a slowdown in housing demand. We've seen single-family home sales, new home sales soften over the last few months. And at the same time, builders are navigating some pretty tough cross currents from rising construction costs, tariff uncertainty. So it's not an easy time to be a builder right now.
Here was the bottom line. I want to read you this, Danielle, from the economist Stephen Stanley. He's a smart guy. He wrote his clients this morning. Here's how he sums it up. He says, I look for a sustained period of weakness in residential building activity extending through the summer and likely into the fall. That does not sound great, Danielle. Does it line up with your forecast?
I think that's right. The home building environment is especially tough because we already see the softening in demand. And at the same time, we have an increasing number of existing home sales on the market. So there's more complementary inventory that builders have to compete with. And even in the existing side of the market, we're seeing sellers get somewhat frustrated and in an increasing number of cases pulling their homes off of the market because they're not necessarily getting the price they want. Builders don't generally have the flexibility to pull their home off the market. They just kind of have to navigate through it. So I don't think he's off the mark there.
Lou, I want to get you in here. I know you think about this housing market as well, my friend. What do you see ahead?
Yeah, I mean, I thought it was bad to be in the energy sector, but then I get this data here where sentiment's low, prices are down. You're looking at basically affordability being really high. I look at this. This is the biggest frustration I'm sure that most home builders and investors here are facing. There's a definitive and structural supply imbalance. We need about 3 million more single-family homes, and yet we can't build them and get them sold at prices that are attractive. So I think longer-term housing is going to be a great place to be. In the short term, affordability is such a problem that I think everyone is waiting. I think the last survey I saw, that was 67% of home buyers were waiting for rates to come down and prices to come down before they actually pulled the trigger, which if having the consumer on pause with the Fed on pause, I'm not sure that the consumer is going to wait and act first before the Fed does.
Danielle, Lou brings up this issue of affordability. It's a familiar narrative. We've been talking about it for a while, Danielle. I'm just looking at Mortgage News Daily, 30-year fix, 681, Danielle. As you try to model this out, where could we be, Danielle, 6 months from now, 12 months from now?
Yeah, it's really tough to model because we've got a lot of fiscal uncertainty. You've got a lot of uncertainty with respect to the economic outlook, what's going to happen with inflation, how much are tariffs going to pass through and be transitory versus stick around and be something that the Fed has to navigate through. So I do think it's difficult for forecasters. That obviously makes it difficult for decision makers, home buyers, and others to predict what's going to happen. I think the best way to approach the market, if you are going to be in the market right now, is just to test out a bunch of different scenarios so that you can react nimbly no matter what happens. I will say, despite all of this uncertainty, we've seen a period of rather steadiness in the mortgage rates. So mortgage rates have been roughly between 6.5% and 7% since late September. So despite all of the uncertainty, they are remaining relatively high where they are, and that is something that consumers can consider as they're shopping.
Danielle, one final question. Can you walk me through this trend of delistings? What do we mean by that? Walk us through it.
Yeah, so when you put your home on the market for sale, we say that it's listed with generally the MLS, and then you put it up for a period of time. Generally, that period of time ends when you get an offer and then ultimately a buyer and your home sale closes. But sometimes you might have a listing for a period of time, say 90 days, 120 days. If you don't get an offer that meets your satisfaction in that period of time, you can choose to just let your listing expire, or you could pull it from the market before then and say decide not to sell your home right now, or in some cases maybe you pull it off and try to find another agent to work with potentially. But so delistings are an indicator of something not going right and the sale not going through potentially in the way that the seller envisioned.
Danielle, always good to see and to have you on the show. Thank you.
Thanks for having me.
And a big thank you, of course, to Lou Basenese for hanging with me today. Lou, it was great to have you. Any final thoughts for the viewers, Lou?
Buckle up. We got big tech earnings over the next 2 weeks. I think everyone hates to say that they really determine the direction of the market, but you got to accept it. That's the reality. So I'm excited. I think you're seeing good, strong reports initially coming out of the chip makers, financials. I think the stage is set for this rally to continue on earnings.
It's been solid, but buckle up is right. Lou, great to see you as always.
Good to be here, my
Thank
friend.
you. Time now for what to watch. Starting off on that earnings front, a massive spread of earnings coming up, including Coca-Cola, General Motors, Google parent company Alphabet, and Tesla. Tesla announced results for the second quarter on Wednesday. Analysts expecting Elon Musk company to meet estimates for Q2. That's driven by stronger sales of the updated Model Y, but the recent rollback of EV tax credits under President Trump's big, beautiful bill, that could pose challenges for Tesla going forward. Also taking a look at the Federal Reserve, we're going to be getting some commentary on Tuesday from Fed Chair Jerome Powell. Powell's going to be making remarks at a banking conference in the morning. This coming against the backdrop of continued pressure we know from President Trump to cut interest rates. Chicago Fed President Austin Goolsbee telling Yahoo Finance on Friday that Fed independence from political interference is absolutely critical. And moving over to housing, fresh housing data coming in on Thursday with new home sales. Economists forecast that number to rise to 650,000, signaling a stronger demand for new homes and suggesting that buyers are feeling more confident about that housing market. That's going to do it for today's Market Domination Overtime. Be sure to come back Monday at 3 p.m. Eastern for all of your coverage leading up to and after closing bell. But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.